Howdy, and welcome back to the channel. Thank you for clicking in. You got Digital Asset Hutch here, bringing the all you need to know about crypto and the U.S. economy. Now let me go ahead and dive right in. As y'all can see, what kind of got y'all clicking in today is that federal funds data. And I do want to go ahead and highlight some important things in this article. With that meeting coming up in February, on February 1st, I did think it was an appropriate time to put this on y'all's radar. So if you could, just go ahead and drop a like below and subscribe. That way y'all can keep and stay up to date with all of the U.S. economy, Fed funds, CPI, Bitcoin movement, and things of that nature. So let's go ahead and dive right in. And as you can see here, that the Fed did indicate that they were still trying to bring it up to 5% in December. And I do think that they are still trying to get above that 5%. Now, in terms of how far into 5%, that is a little different in my opinion. I do believe what they are saying about February and March is true. As you can see with our CME tool, that in February there is a 99% chance that we are going to go ahead and get that 25 basis point hike. And then if you go ahead and look at the meeting following it, there is an 80% chance we're going to have another 25 basis point following that. The reason why this could be 20% is it does also take into account the previous meeting. So I guess they added 1% into there, so roughly about 19% next meeting that it would stay the same. So let's go ahead and get this charted on a graph for y'all so you can kind of understand and see it better, because I don't think they're telling you the full truth in my opinion when it comes to what happens after May's meeting. So let's go ahead and chart it out for y'all. So about 25 from here is, we'll just say 4.45, and then you go here over a little bit, and then the following meeting would put you right there. So just based off of the data that we got from them, you can see that this is where it would put us. We're still below that 5% or that 5% line. And that's why I kind of wanted to highlight this for y'all, because in that May meeting, you can see here that the percents get scattered a little bit more. As you can see here, that what I mentioned before, that this is also taking into account the previous meeting, so there's no guarantee. Just in case one of those did go flat, you will see an adjustment here, but they're kind of getting flatter and more level on, we're not sure what's going to happen. Now, there could be a couple of reasons why that this is the way it is, and one could be with the employee data and unemployment data that is coming out recently. So as you can see here, we are starting to trend possibly back up, like we possibly found a bottom from employment dropping. And why is this important? Because when people are employed, it's kind of stimulating the economy. People have more money, they can go spend money on goods, then they can also go and pay their taxes from the money they earned, which is good for the government. And then when they're getting money from employees, they'll typically lower rates because they are now getting funds from that earned income and the tax brackets for that. So that's why it's kind of important to highlight this. As you can see here, I did kind of highlight what I just mentioned, so if you wanted to read through that. But as you can see on the graph, typically when we do get these sharp declines, we go into recessions. And then also the definition of a recession is 2 negative GDP quarters. So like I've been saying this entire time, I do believe that we have been in a recession this entire time. I think they are just downplaying it for political purposes, just because you did see that the decline with employment, which you can see almost every time in the past that has happened, we've been in a recession. And then also with those 2 negative GDPs, obviously that makes it into a recession. So those are something to kind of highlight, that we are seeing that turned around, which could cause that May meeting not to actually go above 5%. But in my honest opinion, and it does from what the looks of the economists are saying, not the federal funds experts, is that they see a 1 in 3 chance of that happening as well. So if you kind of go ahead, they don't believe that the Fed is going to start cutting rates at all by November and December. They think that we could still be, staying plateaued or possibly going up a little bit. Um, and that's why in this Forbes article they do highlight May as that meeting to look out for. Because in my opinion, I do see that we could go ahead and see that 0.25% hike. The only possible way we don't, I would say, is if we had a huge hiring wave or something of that nature, or if the CPI data did drop all the way down to 2%. As you do know, we did cover CPI in this video, and it was at 6.5 at the last meeting. Now, the data does come out February 14th, which is 2 weeks after the next Fed Fund meeting, so that is something to keep in mind for y'all as well. So just pay attention to all of that information getting thrown out you. So if you didn't go ahead and view this video, go back in and follow, subscribe, drop a like on it, and watch, because it does have some useful information in terms of what could happen. Now, kind of just lastly, to close it out for y'all, I want to kind of show you on the graph what could happen just from the standpoint of this article, and then kind of how I see it just through history, that employment data we looked at, and things of that nature. So like I did mention, they do think it is only a 1 in 3 chance they do start cutting rates by November or December, which I tend to agree. Once we do get on that chart, you will see why. And then also, if you kind of go ahead and see in here, I did highlight that the bond market is kind of the controlling indicator, which is why it is important for you all to know this. Why it's important to keep track of the federal funds rate, because if there is a decline in the Fed rates, that means interest rates for bonds will typically start to decline, and then people will start moving away from risk assets, because if a risk asset is giving you 5% over the course of a year compared to a stock that could potentially go down or up, and its upside is only a 10% potential, people are going to be more willing to invest in those bonds because there is a preservation of capital and there's no risk of them losing that depending on the type of bond they get. So that is kind of why it is important to keep up with this data, because it does show a shift from when people could potentially to start moving back into the risk assets. So as you can see here, I did go ahead and already chart this out from where I agree exactly with what the Fed is saying. Now, they say we could start seeing some plateau in May, but I think what we could have is another 0.25 hike to actually get us above that. And then they think we stay flat all the way up until here, and this is when we could start seeing those movements down again. So it's about in this range. Now, if you kind of look at the history, we haven't stayed in that range for shorter than at least 75% of the year. And if they were going to go based off of just this information right here that they gave us, after May and June when it starts to plateau, that's only about a year and a half. So this is something I did want to highlight for y'all, because if you go ahead and here, typically just throughout the history, at this point right here is when we start to see, sorry, let me get these moved over. Typically it'll stay here to here. Typically you'll see in this range, let me go ahead and draw a box for y'all so you can see it better. Sorry, where is it? There it is. So typically in this range right here is that time frame before you start seeing it to go down and reverse. And why is that reversal important? Like we mentioned earlier, that's when people will start to move into those risk-heavy assets. So, I do believe that at the end of December of this year, it's not when we start seeing it, barring any of those, things we mentioned earlier, like employment rising again. I do think that it could continue to bleed into 2024 for that first quarter. As you can just see from the time, the longest they ever did hold it there is for 413 days. So if we get to this peak and we went to 413 days, that would put us roughly around May of 2024 before we start seeing that reversal. And then as you can see from previous cycles, we do kind of fall off a lot faster than we did going up to it, but we do kind of get caught up for about 100 days um, before going back down again. So that is something to keep in mind, and I did want to point this out for y'all. I hope you did learn something today about the federal funds and why they're important to keep track of. If you could, please drop a like below and subscribe, and I hope you guys enjoy the rest of your day. Stay safe out there, and bye-bye.